I did. You did. Face to face in New York.
Okay, and I saw them, yes, he saw them. I saw them in DC.
One thing, like you said, there was different dialogues going on. The one thing I think I did contribute was I asked them to write what they think. And I think
Folks will probably get us mixed up.
you know, OGC and their idea of what it should say. Yeah.
Good morning, everyone, and welcome. I call this meeting of the NCUA Board to order. In addition to those joining us in the boardroom today, I want to note for the record that today's meeting is open to the public through a live webcast as well. For anyone watching online, if you would like to view the closed captioning of this meeting, please click the CC icon located in the lower left corner of the WebEx window. You may also change the layout to one of your choosing by clicking the layout option on the top right side of your screen. Before we begin our formal agenda today, I would like to address an important issue. Last weekend, federal banking regulators took decisive action to protect the U.S. economy by strengthening public confidence in our banking system. Their actions will ensure that the U.S. banking system continues to perform its vital roles of protecting deposits and providing access to credit to households and businesses in a manner that promotes strong and sustainable economic growth. I know that these interventions have led some to ask how this news impacts the NCUA, credit union members, and credit unions overall. First, I want to assure everyone that the credit union system remains well capitalized and on a solid footing. What's more, the NCUA is well positioned to address. I need to take a break, if that's okay.
Okay. Sure. Rodney, this is our chance right now. We just.
Thank you so much for that short break. First, I want to assure everyone that the credit union system remains well capitalized and on a solid footing. What's more, the NCUA is well positioned to address any issues that may arise from broader market concerns about liquidity in the financial services sector. The NCUA is prepared because of our team's hard work and dedication throughout the years and a steadfast commitment to being risk-focused and ready to act expeditiously at credit unions. We will continue to monitor credit union performance through the examination process, off-site monitoring, and tailored supervision. In addition, the agency continues to coordinate with other federal financial institutions regulators to ensure the overall resiliency and stability of our nation's financial services system. It's also important to remember that credit unions have access to a wide range of liquidity sources, including important federal liquidity backstops. The NCUA Central Liquidity Facility can serve as a backup source of liquidity to member credit unions. The Federal Reserve's discount window and the newly created Bank Term Funding Program are also available to well-run, well-capitalized credit unions. Information about the CLF is available at www.ncua.gov/CLF, and background about the Federal Reserve's discount window and funding facility can be found at frbdiscountwindow.org. As always, the NCUA is committed to protecting credit union members and the safety and soundness of the credit union system. And this point I must underscore. No one, repeat, no one has ever lost a single penny of insured share deposits within the credit union system. In fact, more than 91% of all share deposits are currently federally insured. Credit union members can find more information on their share insurance coverage by visiting mycreditunion.gov. Nevertheless, Recent events provide a good reminder of the dangers of concentration risk and the need for effective risk management policies and practices in the areas of capital, interest rate risk, liquidity risk, and credit risk. Those fundamentals have remained true throughout all economic and regulatory cycles. And these risks were already highlighted as areas of focus in the NCUA supervisory priorities for this year and the last several years. In sum, credit unions must remain diligent in managing risk and ensuring their safety and soundness. Consumers can remain confident that their hard-earned deposits at federally insured credit unions are safe, just as they always have been, and that the NCUA will continue to act expeditiously when needed to preserve the stability of the credit union system. That concludes my opening remarks. I now recognize the Vice Chairman.
Thank you, Mr. Chairman. The events of the last week took me back, not in a good way, to 15 years ago when I was an employee of Lehman Brothers. And, you know, it's a Friday night, you work at a company, it had been doing great for a long time, and you go into a weekend where the government has 48 hours to figure out what happens to your entity. Now, of course, just to make it even more interesting, this past weekend was only 47 hours. Because we did the spring forward.
Fair point.
Yeah. Just to, even though there's no analogy to Silicon Valley Bank and the credit union system, previous boards and this board have been urging credit unions to ensure they have appropriate sources of emergency liquidity. At the same time, we have urged Congress to strengthen the Central Liquidity Facility, CLF, by allowing corporates to act as agents for subsets of members. When interest rates started rising, we published guidance on NCUA's NEV, Net Economic Value Methodology. That guidance clarified that credit union management must have an appropriate plan for managing interest rate risk. I'll also note we, a little while back, encouraged the use of interest rate derivatives for exactly situations like this. The events of this past week underscore exactly why we are so concerned about interest rate risk. And this board is very aware that it is fairly unprecedented, the rate hiking cycle we've been in. We know it's not easy to manage, but that is what credit union management is paid to do. I'm grateful for the hard work by credit unions and NCUA to ensure confidence in a safe and sound system. I know springtime is often annual membership meeting season for a lot of credit unions. No doubt some members will have questions. I hope you, credit unions out there, will use this opportunity to educate members not only on your credit union, but on the credit union difference. Back to you, Mr. Chairman.
Thank you so much. Board Member Hood.
Thank you, Mr. Chairman, and good morning, everyone. I also would like to underscore that America's credit union system is safe and sound. I, too, along with the Vice Chairman, it did take me back to 15 years ago when I saw what played out with the debacle that we've seen from Silicon Valley Bank and Signature Bank. In fact, I was here during the last Great Recession, and I want you all to know, ladies and gentlemen, that this is not a repeat of what we saw in 2008. Yes, that was definitely a credit crisis. What we're seeing here play out, you all, is a bit of a confidence crisis, as evidenced by the folks lining up to get their funds. But as the chairman said, and as I will reiterate, please be confident that your funds are safe in America's federally insured credit unions. Please know that not one penny has ever been lost. And do know that this board and our senior leaders are working to ensure that we keep our system of cooperative credit safe and sound so that our nearly 135 million members will continue to have access to affordable financial services. Another area that I'd like to note is that, yes, as we monitor the situation, we are probably going to glean a great deal of insight about what did transpire with Signature and Silicon Valley Bank. But do know that we have the wonderful, dedicated team of professionals here to help navigate the troubled days that may lie ahead. These are the same folks, the teams from our regional directors, our folks from WANS, our folks from Examination and Insurance, all of the folks that worked together, you all, to bring us out of the recession 15 years ago. I think you know that they have the core competencies to position the agency and our system for continued success. Nowhere is that more apparent, in my opinion, than we look at the near 11% of capital that we see now in the credit union system. So again, that wasn't the same level of capital over 15 years ago. So the two are not the same. And it does trouble me when I see news pundits trying to say that the two are quite similar, and that they are certainly not. In addition to having a strong team here to help navigate, I would also like to note for credit unions, you have a lot of tools in your arsenal to help you in the days ahead. So I ask that you use balance sheet management tools. Are you looking at things that you can look at duration risk? Are you looking at those mismatches that may occur between your assets and liabilities? In fact, in a few moments, we as a board will be working on one of your balance sheet management tools, and that is the subordinated debt rule that we'll soon be voting on. Interest rate risk, yes, we are wanting you to work diligently, and how do you navigate this rising interest rate environment? We've provided you tools in your arsenal for that, whether it be interest rate swaps or, as the Vice Chairman mentioned, derivatives contracts. Again, the tools are there. And also, liquidity. We have a plethora of tools that you could avail yourselves of, whether it be the Central Liquidity Facility, working with the Federal Reserve in its discount window, and the new Treasury program. So you all, there are tools to help navigate the road ahead, coupled with our experienced team of leaders here. So I want you to know, be confident that our system is safe, be confident that your funds are safe, and be confident that the board really wants to ensure that we have a safe, sound, and robust credit union system. Thank you, Mr. Chairman.
Thank you so much, Board Member Hood. Now turning to our agenda, the only item of business today is Final Rule, Part 702, Subordinated Debt. Staff presenting Tom Fay, Manager, Capital Markets, Office of Examination and Insurance, and Justin Anderson, Senior Staff Attorney, Office of General Counsel. Tom and Justin, please begin when you're ready.
Good morning, Chairman Harper, Vice Chairman Haltman, Board Member Hood. Tom and I are here today to present a final rule that would make several changes to the subordinated debt rule. Two of the changes are aimed at the length of regulatory capital treatment for grandfathered secondary capital and the maximum maturity for new issuances conducted under the subordinated debt rule. The remaining four changes are technical in nature and designed to make the rule clearer and more user-friendly. The changes for this final rule, similar to the subordinated debt amendments the board finalized in December of 2021, originated to accommodate the Department of Treasury's Emergency Capital Investment Program, or ECIP. For background purposes, the ECIP was established by Congress in the Consolidated Appropriations Act of 2021. Relevant to this final rule, the ECIP allowed eligible institutions to select either a 15 or 30-year maturity for investments. Under the current subordinated debt rule, grandfathered secondary capital retains regulatory capital treatment for a period of 20 years from the later of the date of issuance or January 1st, 2022. In addition, the subordinated debt rule contains a maximum stated maturity of 20 years for new issuances. As discussed in the proposed subordinated debt rule, the maximum 20-year maturity was included to help ensure issuances were kept squarely within the debt space, as federal credit unions only have the statutory authority to issue subordinated debt under their authority to borrow from any source and do not have authority to issue equity securities. In October of 2021, the agency issued a letter to credit unions clarifying that low-income credit unions could issue 30-year notes under the ECIP program. In December 2021, this board finalized a rule that permitted secondary capital issued to the U.S. government under an application approved by the end of 2021 to be considered grandfathered secondary capital irrespective of the issuance date. While these two actions help facilitate credit union participation in the ECIP, there is a natural mismatch between an instrument with a 30-year maturity that only received 20 years of regulatory capital treatment under the subordinated debt rule. Today's rule therefore eliminates that mismatch and provides credit unions with additional flexibilities. With that being said, I will now shift to the changes contained in the proposal and this final rule. First, to address the mismatch I just mentioned, this final rule would extend the regulatory capital treatment for all grandfathered secondary capital to 30 years from the later of the date of issuance or January 1st, 2022. I want to reiterate that this change would apply to all grandfathered secondary capital. This change would also close the final loop between the ECIP and the NCUA subordinated debt rule and allow credit unions to take full advantage of the program. Second, this final rule would replace the maximum fixed stated maturity of 20 years for new issuances with a rebuttable presumption. Specifically, under this rule, if a credit union seeks to issue subordinated debt with maturities longer than 20 years, the credit union would have to demonstrate as part of its application why the instrument is still considered debt. The remaining changes are unrelated to regulatory capital and the maturity issues, but rather are technical changes designed to make the subordinated debt rule clearer and more user-friendly. First, the final rule would amend the definition of qualified counsel to clarify that the intention was never to mandate that such person be licensed to practice law in every jurisdiction related to the issuance. As such, this rule removes the phrase "in the relevant jurisdictions" from the definition of qualified counsel. Second, the final rule would remove the statement of cash flow from the pro forma financial statements requirement and replace it with the requirement for cash flow projections. The primary difference between a pro forma financial statement of cash flows and a cash flow projection is the former is a formal accounting statement and the latter is not. The final rule recognizes that a cash flow projection analysis is sufficient to evaluate the viability of an issuance. Third, this final rule would amend the subordinated debt rule, the section of the subordinated debt rule addressing the filing of documents. First, this rule would amend the title of the section by removing the phrase "inspection of documents," as there is no formal mechanism included in this rule for inspecting documents outside of the Freedom of Information Act. Second, the final rule would replace the current requirement that a credit union submit all applicable documents via the NCUA's website and replace it with a requirement that credit unions make all submissions directly to the appropriate supervision office. This change would merely codify current industry and agency practices. Finally, this rule would remove a parenthetical reference to discounted secondary capital, recategorized as subordinated debt, from the grandfathered secondary capital section of the rule. This change would align this section to the current treatment of grandfathered secondary capital on the call report, which was revised in the spring of 2022. In response to the proposed rule, the NCUA received 21 comments. 2 of these commenters supported the rule as written, 2 opposed the rule, and 17 supported the proposal but offered additional comments which are outside the scope of this rulemaking. The 2 commenters that opposed the rule generally disagreed with permitting longer maturities for new subordinated debt notes. The commenter stated that longer maturities would make these instruments more equity-like, which is outside the statutory authorities for federal credit unions. The change in question is merely a recalibration of the agency's position. As this rule and the proposal note, the agency has never viewed 20 years as a magic number, but rather an advantageous demarcation point to help ensure issuances under the subordinated debt rule are considered debt. However, the agency has always recognized that courts have never set a strict maturity limit, and the maturity is but one factor in the debt versus equity analysis. Therefore, 20 years would still be used as a demarcation point, but this rule would allow additional flexibility for credit unions that seek to issue notes with longer maturities, provided such credit unions can demonstrate that the notes would still be considered debt. To satisfy this requirement, this final rule permits the appropriate supervision office to request that a credit union seeking a longer maturity provide an attestation, a CPA opinion, or a legal opinion concluding that the issuance is debt. As such, this rule contains adequate safeguards to help ensure issuances under the subordinated debt rule remain squarely within a credit union's statutory authority to borrow from any source. Therefore, in consideration of the comments and as further explained in the preamble to this final rule, staff recommends the board adopt the proposed changes without further amendment. This concludes our presentation, and we are happy to answer any questions.
Thank you, Justin and Tom. For years now, NCUA considered how to create a regulatory environment where credit unions could utilize alternative forms of capital, such as secondary capital and subordinated debt. NCUA formed a working group on secondary capital nearly 10 years ago, which kicked off a significant effort by the staff and board. We voted to finalize that rule in December 2020. Shortly after, Treasury's Emergency Capital Investment Program, ECIP, provided an unprecedented opportunity for additional capital. But for credit unions to take full advantage of that program, specifically treating Treasury's 30-year certificates as regulatory capital, that required additional adjustments, which leads us to where we are today. Much of today's final rule deals with syncing up the subordinated debt rule with Treasury's ECIP program, which I know is a welcome change. This rule also brings welcome flexibility to the maximum maturity of subordinated debt notes. I also appreciate the clarity on the qualified counsel, cash flow projections, and the filing requirements. Although it's outside the scope of today's rulemaking, a few important points about sub-debt bear repeating. Subordinated debt in a credit union is a debt security, not an equity security. I'll also say subordinated debt is subordinate to all other claims against issuing credit unions, including those of members, other creditors, and their share insurance fund. Those who buy subordinated debt get paid last in the event the credit union is liquidated. Subordinated debt is a powerful tool that can assist credit unions in bringing financial services to underserved communities. And chartering new credit unions is one of my priorities. Additionally, we're working on a provisional charter option which can solve the chicken and egg challenge of we need capital to get a charter, but we need a charter to get capital. Anything that makes it easier to start a new credit union is a step towards true financial inclusion. I'm going to stop my remarks there, and I'm going to ask a couple questions. I'm also going to try to ask Chairman Harper's questions so we can get these on the record, okay? So, question for you. We need to ensure that bilateral secondary capital deals for smaller, low-income credit unions continue to take place. If that's a problem, then we should fix it. Some have also suggested that such deals may have dried up because of the change in interest rate environment over the last year. That may be the case for some deals, but I'm aware, again, this is Chairman Harper speaking, that Inclusive launched a $20 million racial equity investment fund to deploy secondary capital investments at minority depository institutions. These funds have an interest rate of just 2%, identical to the rate offered under ESIP, which would advance financial inclusion efforts within communities of color. Yet none of these funds have gotten deployed. Tom and Justin, would you look into what more can be done by NCUA to expedite the release of this funding? Can you also report back to the board in 6 months about Inclusive's success in getting the racial equity investment fund deployed and any progress made by smaller low-income credit unions in obtaining non-ESIP secondary capital funds?
Yes.
Yes.
Okay, thank you for that commitment. In developing this rule, we did not intend to cut off a critical funding stream to improve financial inclusion within under-resourced communities. We remain committed to getting this rule right and taking further action, whether through regulatory amendments, additional guidance, or some other means. That concludes the remarks of Chairman Harper. I am going to now ask my question, which is, what do you think would have to change to get bilateral agreements to go back to where they used to be?
I'll respond to that question. I think we would need to really take a deep dive back into the rule and meet with interested stakeholders to see what their concerns are and how those concerns may be alleviated by the rule, if there are things that need to change or things that may need to be clarified. That concludes my response.
Sounds good. And the Federal Credit Union Act is clear that credit unions may only issue debt, not equity. Do you have any concerns that a note outside 20 years, beyond 20 years, is outside that statute?
I'll take that question. This final rule contains sufficient safeguards, namely a requirement that an applying credit union include in its application sufficient evidence to demonstrate how a note with a longer maturity would still be considered debt. This requirement will help ensure that the subordinated debt issuances continue to stay squarely within the debt space and within a credit union statutory authority.
Thank you. Over to Mr. Rodney Hood.
Great, thank you, Mr. Vice Chairman. And Justin and Tom, thank you for your presentation. I want to begin my remarks this morning by stating that I will be enthusiastically supporting today's final rule. I would also be quite remiss if I didn't thank Chairman Harper and Vice Chairman Heltman for their work in bringing forth this final sub-debt rule forward several years ago. So this is something we've been looking at for almost 2 years now. The current sub-debt rule restricts the maturity of subordinated debt notes to a minimum of 5 years and a maximum of 20 years. The subordinated debt rule further caps the regulatory capital treatment of grandfathered secondary capital at 20 years. Under the ESIP, the Treasury allowed 30-year subordinated debt instruments. While supervisory guidance from our Office of Examination and Insurance and a rule finalized by this board in December of 2021, while it all facilitated LICU participation in ESIP, the agency recognized that there is, in fact, a distinct mismatch between a 30-year ESIP subordinated debt instrument and the 20-year maximum regulatory capital treatment under our very own regulations. To address this discrepancy, the board is bringing forward today's final rule, which again, I'm very pleased. In addition, in today's rule, the board also recognizes that a fixed stated maturity date is but one factor in a debt versus equity analysis, and as noted by the U.S. Supreme Court, and I'm going to quote here, there is no one characteristic which can be said to be decisive in the determination of whether obligations are risk investments in the corporations or debt. Let me repeat. There is no one characteristic which can be said to be decisive in the determination of whether obligations or risk investments in the corporations or debt, end quote. And recognizing that the maturity is but one factor in determining if an instrument is debt or equity, I'm pleased that this final rule adds additional flexibilities for credit unions while maintaining strong guardrails to ensure subordinated debt issuances remain within a federal credit union's statutory authority. I'm really also pleased that ESIP provides our minority depositories and CDFIs with the resources to continue providing access to affordable financial services for the most vulnerable in our communities. With that being said, you've heard me say, and I'm going to say it again, financial inclusion is the civil rights issue of our generation. And again, I believe that ESIP is going to bring greater capital and opportunity for credit unions to serve marginalized communities. I also applaud this program because it ties into our agency's access initiative. It ties into advancing communities through credit, education, stability, and support. I'd also like to, everyone, note just for the record, when Congress did give the opportunities for ESIP program during its creation, they had no knowledge at the time that NCUA had the 20-year limitation. So it was congressional intent from the beginning that it would be both banks and credit unions all having 30-year terms. So I'm delighted that we're able to have parity with the other financial institutions. I do want to point out the rapid growth of sub-debt instruments in the credit union system over the past years. So gentlemen, for the record, how many sub-debt instruments were utilized in the credit union system as of December 31st, 2022, relative to December 31st, 2021? And how much of this is in government grants versus private markets?
Mr. Hurd, I'll take that question, give Justin a break.
Thank you.
2022 was a very busy year in terms of subordinated debt activity. Congress's ESIP program, as of December 22, had largely settled with 73 credit unions participating for a total of $2.1 billion. That program will have a few additional settlements in 2023, as well as an additional interest as Treasury proceeds with a round 2 of the ESIP program. To get to your question, as for privately issued transactions, there were approximately 22 transactions totaling $385 million. To provide some perspective, the $385 million issued last year, that amount exceeds what was historically outstanding in the industry at any time up to 2020. That concludes my response.
Great, thank you, Tom. What is the staff's interpretation of the growth in sub-debt instruments in the credit union system?
I'll take that. So, good question. I'll give you what I think is really the best response to this. I mean, staff believes if subordinated debt is done safe and soundly, obviously with the utility of being a capital instrument, can be an effective tool for managing new membership services and for liquidity risk.
Exactly.
That concludes my response.
Good point, especially relevant today. For the record to date, how many times have the regents approved the use of sub-debt, and how many times has it been rejected?
As I previously mentioned, 2022 was a very busy year for subordinated debt transactions. There were approximately 30 applications submitted to NCUA for regulatory capital treatment. Some have issued, and some are still pending issuance. There was also approximately 5 credit unions whose applications were denied.
Okay.
That concludes my response.
Thank you. And Tom and Justin, I've also been asked by credit unions why sub-debt only counts toward the net worth ratio for low-income designated credit unions. For the record, can one of you please elaborate on that?
Thank you, Board Member Hood. I'll take that question. Under the Federal Credit Union Act, Congress only permits low-income credit unions to count these instruments as net worth. As such, this limitation is statutory rather than regulatory. It's worth noting, however, that the subordinated debt rule does permit complex credit unions to count subordinated debt for risk-based capital and leverage ratio purposes, and new credit unions can use subordinated debt in complying with their PCA requirements. This concludes my response.
Great, thank you. Well, I was just saying in closing, I again am delighted and pleased that many of our like-us have regulatory benefits, like counting sub-debt to count towards the net worth ratio. But I do think it would be important that the agency look for opportunities to brainstorm additional benefits for being a minority depository, and perhaps even work with Congress to make legislative changes that may be needed to accomplish this. So like-us get to do it, but would love to see the MDIs have that same flexibility. You all, I have no further questions or comments.
Thank you, Mr. Hood. I will make the motion. I move that the board approve final rule, part 702 of NCUA's rules and regulations as attached to the board action memorandum. Is there a second to the motion?
Yes, Mr. Vice Chairman, I second the motion.
There is a sufficient second. All in favor say aye.
Aye.
Aye. The ayes have it. Let the record show the motion passed 2-0. That concludes today's meeting, and we are adjourned.